Welcome back, curious minds, to another deep dive. Today, we're peeling back the layers on Genting Berhad, a name, synonymous with global leisure and hospitality.
Huge name.
We've talked about their broader movements before, but are their ambitious multi-billion-dollar bets truly building an empire, or are they creating maybe a financial tightrope walk?
It's a really critical question right now. Genting is a company with immense global reach, and its performance often serves as a fascinating barometer for wider economic trends, especially in that consumer discretionary space.
Absolutely. So our mission today is to dive deep into their second quarter 2025 performance, analyze the current trends, and sort of peer into the future to see what lies ahead.
Yeah, what's coming down the pike?
We've sifted through fresh reports, financial statements, expert analysis. Think of this as your shortcut to truly understanding what's driving this multifaceted conglomerate and whether their grand vision's about to pay off or maybe unravel for investors like you.
It's more than just an update. It's really about connecting the dots in a complex global economy. It really is.
Okay, let's unpack this then. We'll kick off with the headline numbers for the second quarter of 2025. Genting Berhad's core profit for the first half of 2025. Well, if we strip out a significant one-time disposal gain, about RM 338 million and other exceptionals, it actually landed well below market expectations.
Yeah, quite a bit below.
We're talking about a core profit of just RM 83.4 million here. That's a pretty startling figure for a company of this scale, wouldn't you say?
It truly is. What's particularly revealing, I think, is that this wasn't just one isolated issue. The shortfall was largely driven by weaker than anticipated contributions from their key gaming operations, specifically Genting Singapore, GES, and Resorts World Las Vegas, RWLV.
The big ones.
Exactly. Then layer on top of that higher than expected tax expenses, and you start to see, well, kind of a perfect storm forming.
So we're seeing some serious headwinds right from the get-go. And diving deeper into the revenue and EBITDA trends, the story doesn't immediately brighten up, does it?
Not on the surface, no.
Genting's adjusted EBITDA for the first half of 2025 slumped almost 15% year-on-year to RM 4.1 billion. That's on the back of a 7% year-on-year drop in revenue to RM 13.3 billion. Those are some tough comparisons to last year.
They certainly highlight a challenging period. However, it's crucial to look beyond just the year-on-year figures. If we focus on the immediate preceding quarter, comparing 2Q25 to 1Q25, there was a modest sequential improvement.
Okay, so a bit of a bounce back.
A bit, yeah. Group revenue actually improved by 4% to RM 6.8 billion, and EBITDA was up 5% to RM 2.1 billion. Even more notably, net profit more than doubled from about RM 277 million in 1Q25 to RM 680 million in 2Q25. So some green shoots quarter on quarter, but yeah, the annual picture is definitely looking tougher.
That distinction between the quarter-on-quarter recovery and the year-on-year dip is incredibly important to grasp here. And adding another layer of complexity, the strengthening of the Malaysian ringgit against major operating currencies, like the Singapore dollar, British pound, US dollar.
Yeah.
That actually played a role in that reported decrease in revenue and EBITDA, right?
Oh, definitely. And this isn't just, an accounting nuance. It means that while the reported numbers look weaker, their operations in places like Singapore, the UK, and the US might actually be performing better on the ground in local currency terms.
Right.
So the ringgit is effectively making their international successes appear smaller on the balance sheet back home. It paints a tougher picture than might truly exist locally. It's a good reminder to always, always look beneath the surface of those headline figures.
That's a fantastic point. Okay, let's zoom in on where the performance truly hit or missed across their different segments. Starting with Singapore, their Resorts World Sentosa, or RWF.
RWS.
They saw lower revenue and adjusted EBITDA in the first half of 2025. This was mainly due to the absence of that incredible visa-driven demand we saw in 2024, coupled with that stronger ringgit we just discussed. Plus, RWS is right in the middle of major transformation-related disruptions.
Yeah, and those disruptions are pretty much unavoidable with the massive RWS 2.0 project they've got going on. It means parts of the resort are undergoing renovation, which obviously impacts things. Similarly, in Las Vegas, Resorts World Las Vegas, RWLW, that also had its revenue and adjusted EBITDA impacted by lower visitation and just general macroeconomic uncertainty. People being a bit more cautious. Hotel occupancy in the second quarter was down to 80.2% from almost 90% a year ago.
Ouch.
though their average daily rate, the ADR, actually nudged up slightly to USD 265, so they're charging a bit more per room. They also experienced a weaker hold percentage, basically how much the house wins from players in Q1, but thankfully that seems to have normalized in Q2.
So a bit of a mixed bag there in Vegas, but some positive news emerged from their home turf. Malaysian operations, Resorts World Genting, or RWG.
RWG.
Yeah, that actually showed encouraging signs of recovery. They posted higher revenue and adjusted EBITDA in Q2, thanks to an overall higher business volume in their gaming segment. It seems local and regional visitors are definitely making their way back up the mountain.
Yes, that's a really vital sign of domestic market resilience for them. Now, for their UK and Egypt operations, revenue was higher primarily thanks to the newly acquired Stratford Casino.
The new acquisition helping out.
Exactly. However, adjusted EBITDA saw a slight decrease in local currency if you exclude Stratford,
Yeah.
mainly due to higher operating and payroll expenses. This cost pressure is a recurring theme we're seeing. It's impacting several of their international ventures.
And it certainly impacted their U.S. and Bahamas operations too, didn't it? While they had improved operating performance across Resorts World Omni and Resorts World Bimini, we saw lower adjusted EBITDA overall.
Yeah, same story again.
Again, higher operating and payroll-related expenses in Resorts World New York City, RWNYC, coupled with the consolidation of Genting Empire Resorts, LLC's, adjusted loss, that contributed, it's just hard to escape those rising costs everywhere, it seems.
It really is. And just to round out the segmental breakdown, their other, more diversified divisions had varied performance. The plantation division saw higher revenue and EBITDA, benefiting from stronger palm product prices and increased production. That's good news for them.
Okay.
The power division also saw an increase due to higher generation from their Banten plant in Indonesia. Conversely, oil and gas recorded lower revenue and EBITDA, primarily due to lower global crude oil prices and the weakening of the US dollar against other currencies. It really just underscores how diverse Genting's portfolio is, each segment reacting to totally different global forces.
It truly is a sprawling empire.
Yeah.
Okay, so with all those numbers and details swirling around, let's try and give Genting Berhad a financial scorecard, maybe from 1 to 10, 1 being very weak, 10 very strong.
Okay, let's do it.
And folks listening in, the overall financial score we've landed on is a 3 out of 10.
Yeah, a 3.
This tells us it's been a pretty challenging period, largely marked by those significant capital expenditures and the external headwinds we just discussed.
This cumulative score really reflects the pressure they're under. Let's dissect it a bit further. For profitability and earnings growth, they score a pretty low 2 out of 10.
Just 2. Wow.
Yeah. Their core net profit for Q1 2025 fell short of market expectations, and their basic earnings per share for Q1 essentially evaporated, plummeting by an astounding 99% year-on-year.
99% drop.
It's huge. This has led analysts to drastically slash future earnings projections by as much as 2/3 for FY 25-27. It just signals very low confidence in immediate profitability right now, very weak earnings visibility.
Wow, an almost complete evaporation of earnings.
Yeah.
That's a powerful statement. Okay, next up, revenue growth. This gets us slightly better, but still not great, 4 out of 10.
Yeah.
The overall group revenue declined by 12% year-on-year in Q1 2025 and 7% for the first half of the year. As we touched on, while the strengthening Malaysian ringgit masked some underlying local currency growth internationally, the reported numbers still show an overall contraction.
Precisely. Now, for balance sheet and debt management, we're putting them at a 5 out of 10. Middle of the road, maybe slightly below.
Okay.
Total liabilities stood at a hefty RM 51.18 billion in Q1 2025. And Genting Malaysia's net debt alone jumped quite significantly, from RM 9.9 billion to RM 11.3 billion just in Q2. That pushed its net gearing to 96%.
96% net gearing. What does that really mean in simple terms?
It basically means they're nearly as reliant on borrowed money as they are on shareholder equity to fund their operations and growth. For a company in such a heavy investment cycle, while maybe not completely unheard of, it does tighten their financial flexibility and it amplifies risk if those large projects face delays or underperform.
Right, less wiggle room.
Exactly, and remember they have these massive authorized capital commitments, RM 32.5 billion, mainly for property, plant, and equipment. It just signals a company in a really deep investment cycle. They are actively managing their financing, though, targeting finalization of project financing for their FLNG facility by year-end.
That RM 32.5 billion commitment is just colossal. And then we get to shareholder returns, specifically dividends, which frankly gets a dismal 1 out of 10.
Yeah, that one hurt investors.
This was a real negative surprise for analysts. No interim dividend was declared for 2Q25 and 1H25. For context, last year they paid 6.0 cents per share for the same period. The total dividend for FY 2024 was already cut to 11.0 cents per share from 15.0 cents in 2023.
So a cut and then a halt.
Exactly. This clearly points to, prudent capital management, debt reduction, and funding those massive projects we talked about.
Right.
But it signals a longer path to achieving previous expectations for investors. They're essentially telling shareholders, look, you need to be patient with us.
Very patient. Which brings us to the last part of the scorecard. Operational efficiency across things like ROCE, ROA, and ROE. Here, they score another low 2 out of 10.
2 again.
Yeah. Genting Berhad's return on capital employed, ROCE, was only 4.4% for the trailing 12 months to March 2025. Now, this is significantly underperforming the hospitality industry average, which is around 8.4%.
Big difference.
Huge. And its ROCE has been stubbornly steady, kind of flat, for the past 5 years. That suggests the company isn't really reinvesting profits at increasing rates of return. It really makes you wonder, are these massive capital outlays for RWS 2.0 and the New York bid truly going to add value in the long run?
Or is it just spending for spending's sake?
Or is Genting betting on sheer scale, maybe sacrificing immediate efficient returns for a future that's still very much an open question, and one where their capital is being tied up far less efficiently than their peers? Both their return on assets and return on equity are projected to remain pretty low for FY25 as well.
That's a really powerful insight on the ROCE. So, given these scores, what does this all mean for their economic moat? Their sustainable competitive advantages. It sounds like they're trying to build a bigger moat, but the process itself is proving quite challenging.
Exactly. That's a good way to put it. The company's economic moat faces several significant challenges right now. Firstly, there's the high capital intensity and execution risk. They are in this deep investment phase with that staggering $32.5 billion in capital commitments we mentioned.
Right.
Projects like RWS 2.0 in Singapore inevitably lead to unavoidable disruptions to existing revenue streams. And we've even seen initial delays in the Kazuri onshore gas processing plant's mobilization. Building anything of that scale and complexity inherently carries substantial execution risks. Things can go wrong.
Right. Building empires isn't quick or easy or cheap. And it seems like they're also very sensitive to macroeconomic conditions and geopolitical tensions.
Extreme.
Global economic growth is expected to moderate, remain uneven, with downside risks from persistent uncertainties. That translates directly to lower consumer sentiment and discretionary spending. We saw that with lower visitation in Las Vegas. Broader trade tensions also pose risks. Their core business relies so heavily on people traveling and spending freely.
Absolutely. It's directly tied to their bottom line. You can't escape that. And of course, currency fluctuations remain a consistent headwind, as we discussed earlier. That strengthening Malaysian ringgit continually impacts reported revenue and adjusted EBITDA when translating foreign earnings, making even strong local performance look weaker on paper. It's an external factor they can't control but must constantly navigate.
And those rising operating costs and margin pressures we touched on earlier, they're definitely eroding their moat too, aren't they? Several leisure and hospitality segments, particularly in the UK and US, are experiencing these higher operating and payroll-related expenses, which directly eat into their adjusted EBITDA margins. It's tough to maintain profitability when your input costs just keep climbing like that.
Indeed. It squeezes them from both sides' revenue headwinds and cost pressures. Then there's also regulatory uncertainty and increasing competition to contend with. The outcome of the highly anticipated New York casino license bid is still uncertain. The decision's expected by December 1st, 2025. That's a huge question mark.
Massive.
And looking regionally, the potential legalization of casinos in Thailand could introduce significant new competition right into the Asian market, potentially hitting Singapore and Malaysia. Even their downstream manufacturing segment faces intense competition and overcapacity issues.
That's a lot of moving pieces and potential threats. And we probably can't overlook litigation risks either.
No, definitely not.
Genting Americas, Inc. is involved in ongoing material litigation in a U.S. district court. RAVB Bahamas Ltd. is seeking damages over USD $600 million related to the resort's World Bimini operations.
Yeah, that's a big number.
Now, Genting Americas, Inc. believes the complaint is baseless, but mediation attempts haven't worked, and the case is proceeding. This reminds me of how often in this industry, Even a seemingly baseless lawsuit can just tie up management's focus and capital for years, becoming this shadow over otherwise positive operational news.
It's a significant financial and reputational risk, absolutely, regardless of the merits. Finally, their plantation and oil and gas divisions are exposed to commodity price volatility, which directly impacts their revenue. And as we highlighted in the scorecard, that stubbornly low return on capital employed, the ROCE, significantly underperforms the industry average. That suggests their reinvestment of profits over the past 5 years just isn't generating strong returns, which is a key indicator of a potentially weakening moat.
So a challenging landscape for sure, loads of headwinds, but even in tough times, you'd expect great management teams to always have a vision. What are they looking at for the next 5 years or so to navigate these rough waters?
Yeah.
Is there a glimmer of hope on the horizon?
There is, and Los, they've outlined what seems to be a very clear, forward-looking roadmap. It focuses on resilience, productivity improvements, and importantly, long-term growth across their diverse portfolio. So in Malaysia, for Resorts World Genting,
RWG.
they're enhancing its appeal with new ecotourism experiences, infrastructure upgrades, trying to optimize yield management, getting more revenue per visitor, and targeted marketing. It's about creating more unique reasons for people to actually make the trip up there.
So really doubling down on the visitor experience itself and in the UK.
In the UK, they're expanding their market presence, like with that recent Genting Casino Stratford acquisition we mentioned. They're enhancing products and rigorously focusing on disciplined cost management to try and counter those rising expenses we talked about.
Okay, makes sense. What about the US? That New York bid looms large.
It really does. For the U.S., they're finalizing a proposal to enhance the capital structure of Empire Resorts, strengthening partnerships for RW Bimini, and critically, yes, submitting that bid for a full commercial casino license in New York State. The plan is to transform RWNYC into a colossal USD 5.5 billion integrated resort. That would be an absolute game changer for their U.S. footprint if they win it.
$5.5 billion. That's a massive undertaking. And Singapore. Still pushing ahead with RWS 2.0.
Oh, yes. Resorts World Sentosa is driving its RWS 2.0 transformation with extensive property renovations, strategic asset refreshes, and new facilities like the Loris Hotel and the Singapore Oceanarium. They're also investing heavily in AI, looking for operational efficiencies. This seems to be a key pillar of their future in Asia, really enhancing their premium offerings there.
Trying to move up market.
Definitely. Now, in Las Vegas, Resorts World Las Vegas is strategically focusing on recovering that crucial VIP play. They're leveraging upgraded hotel and casino management systems to get better customer data, provide real-time offers, and also strengthen their convention business. The goal here is really to drive repeat visitation and attract higher-value guests to improve those occupancy and visitation numbers we saw dip.
Okay, so a targeted approach for Vegas. And beyond leisure and hospitality, what about the other divisions?
Right. Their plantation division aims to improve FFB production and hopefully benefit from stabilizing palm product prices while also expanding its property segment with new developments. And the power and oil and gas divisions are focused on maintaining high plant load factors for power and, crucially, progressing the Kazuri FLNG project. That's about 60% complete now, and they're targeting project financing by the end of 2025. This latter project represents a significant move towards a cleaner energy portfolio for them.
Interesting pivot there.
It's a very comprehensive, long-term strategy that really speaks to their diversified interests, even if the short term is tough. Now, looking specifically at the next, say, 2 years, we've identified 5 top catalysts that could significantly impact Genting Berhad's performance and maybe change the narrative a bit.
Okay, this is where it gets really interesting. These are the potential turning points for investors like you to watch. Number 1 has to be the New York commercial casino license.
Absolutely, number 1.
That decision on the USD 5.5 billion bid for a full casino license for Resorts World New York City is expected by December 1st, 2025. RWNYC's proposal apparently highlights speed, scale, and a proven track record, making it seem like a very strong contender. A win here would just fundamentally transform their U.S. business overnight.
It certainly would. Huge potential upside. Catalyst number 2. RWS 2.0 transformation milestones in Singapore. The launch of the Loris, that's Singapore's first coast, the luxury collection branded all-suite hotel, is slated for October 2025. And the grand opening of the Singapore Oceanarium is expected in Q3 2025.
So tangible openings happening soon.
Exactly. These are significant enhancements to their premium lifestyle and tourism destination appeal. The broader waterfront complex is slated for completion by 2030, but these near-term openings could provide a substantial boost to sentiment and maybe traffic.
Big new attractions coming online. Good point. Catalyst number 3.
Resorts World Las Vegas, RWLV, recovery and enhanced operations. Following the finalization of that Nevada Gaming Control Board complaint back in March 2025, RWLV seems to be making progress in recovering VIP play. We expect to see improvements, hopefully, in high-end play, ADR, and occupancy, driven by those upgraded hotel and casino offer management systems they're implementing. This could finally help turn around its recent weaker performance and attract those high-value customers they need.
Getting Vegas back on track. Okay, catalyst number 4.
Number 4, UK legislative changes and market expansion. Recent legislative changes, which became effective July 22, 2025, actually permitted an increase in gaming machine allocations in casinos across the UK.
Interesting regulatory tailwind.
Exactly. This, combined with the successful integration of Genting Casino Stratford, creates tangible opportunities for further growth and market share expansion in the UK market. It could boost revenues from their existing operations there.
Okay, and finally, catalyst number 5.
Catalyst number 5 is the Kazuri FLNG project financing and construction progress. As mentioned, the construction of this floating liquefied natural gas facility is approximately 60% complete. They're in project financing discussions with regional and international lenders, targeting finalization by the end of 2025. This project represents a really significant long-term investment in Genting's cleaner energy portfolio, moving them into a new and strategically important growth area outside of their traditional leisure business.
Diversification in action.
These catalysts collectively show a clear strategic path for future growth and diversification, even as they navigate all these current operational and economic challenges we've been discussing.
Okay, wow. We've navigated a truly complex financial landscape for Genting Berhad today. While the 2Q 2025 results definitely revealed challenges, profitability, shareholder returns, exposed some weaknesses in its economic moat. We also saw a very clear, very ambitious strategic roadmap for management, significant investments, potential catalysts for future growth.
It's definitely a company in a deep transition phase, investing very heavily for what they clearly envision as a much stronger and more diversified future, but there are clear short-term costs and pressures involved, no doubt about that.
So the final thought for you listening is this. What do these massive capital-intensive projects, from the RWS 2.0 transformation in Singapore to the ambitious New York casino bid and even that FLNG project, what do they tell us about the future of global leisure, hospitality, and maybe even energy? Are we witnessing a strategic bet on sheer scale and immersive experiences over short-term financial returns? And crucially, how long are investors like you willing to wait for these ambitious visions to truly bear fruit and deliver the promised value? Something to ponder until our next deep dive.